So today's class is about the QuickBooks. We'll be working with the QuickBooks desktop, like different exercises. So before starting QuickBooks, just let's understand what are the accounting concepts. So first thing, there is a very simple rule. Whatever you have in business is either your money or it's a money from your you can say partners, or let's say from your lenders. Like, so either you get money from the banks, or you put money from your side, or from your partners, or from your friends. So whatever the source of income is, all the money that you brings in into your like into the business, business itself is an entity. So what happened, let's say, if you let me show you the idea why I'm talking about this way. Let me open Excel. So let's say if it's your money, right? So it's a proprietor's money. If you take loan, it's loan money. So you are injecting this money into your business. So it means right now you don't have any place, you don't have any property, you don't have any, you have not bought any machines, anything. So right now uh, you receive money from these sources. Either it's your money, your partner's money. Let me make it your money, so you get the idea. Maybe it is your money or your partner's money or your friend's investment, or you can say funding, or you're taking loan or loans from bank. So if you got any type of money from your friends, your partners, your money, loans, so the money is collected, right? So now once you collect that money, you have to put it somewhere. So let's say you either it's in the shape of cash in your drawer, or you put it in the bank. So whatever the money you have collected here will be equal to your money in this side. So that's why the equation for the accounting balance sheet is asset is equal to your money, right? So it means equity plus your friend's funding, means a loan from the friends, a loan from the bank. So equity plus borrowing, or you can say liabilities. It's very simple equation. Asset, this is your asset. And when it's your money or your partner's money, this is your equity. Now, the only thing is, like, when you take the money from your friends, that is not your equity, because this you got your friend's investment in your business, or you can say you take a loan from your friends and put it in your business, or you have taken loan from the bank and put it in your business. So these type of loans, they are called liabilities. Like, you need to pay them back, right? So what we know from this equation, our assets, which is here, is equal to equity plus liabilities. As simple as this. Like, if you have your money, your partner's money, loan from your friends, loans from bank. So if you add all of them, you have some money in hand, either in the shape of cash, or in the shape of your deposits in the bank. So you see, that is asset. Your money, your friends, your partner's money is the equity, because you are the owner of the business. So both of yours money will be your equity, or your you can say your capital in the business. All of these words are used for your money in your business. But if you have taken a loan from someone, like from a person or a bank or any other institute, that is your liabilities, because you need to pay them back. Then once you got this money, you need to deposit it somewhere. Either you put in cash in your like in your safe, or you are putting it into the bank. In both the ways, either cash or bank, that is your like asset. So the basic equation is asset is equal to equity plus liabilities. So let's discuss. I just give you the idea that this is the formula and why this formula, how this formula works. So let us discuss some of the examples of equity, liabilities, and then assets, so that we understand more in detail. So once we start working with the assets and liabilities, so now we know that the total of equity and liabilities is equal to the assets. Or I can type here assets, right? Let me, instead of by like typing one by one thing by myself, I can discuss it here, so it will be easier. Balance sheet templates. Let me open up one balance sheet tab. Most Let me stop the recording so I can choose the one which we can see properly. So the same way, I show you that one side is your assets, the other side is your equity and liabilities. The same way, one side is your assets, which is here. All of your current assets and your fixed assets are on one side, and all of your liabilities and equity is one side. And if you see the total of this one and this one is always the same. Why? Because we have just learned in the formula that equity plus liabilities, these are the sources of income for your business, and you put it in your business account. So that business account is actually is comprising of all the money that you get from different sources. Business itself is an entity, like it's a legal entity. When you go to the, once you create a business, you go and register it somewhere, so it has its own entity. So once you register a business, so your account is separate, the business account is separate. Here you can see, even when you're giving or investing your money in your business, that will be part of the source of you get funding into the business. And that's why you see liabilities, payments to your friends or payments to your bank. At the same time, equity, which is actually your money, but actually when it comes to the business needs to pay back this money to you as well. So all those things, like sources of income to the business, will be on one side. Whatever the business has gained will be on the other side. So the formula is assets equal to equity plus liabilities. So now let's see more in more detail what are the assets and what are the liabilities. So one thing, when we are discussing about the liability, let's discuss with the assets. So when we are discussing about the assets, it is divided into two types. One, which is cash or cash equivalent. So let's say if you have cash, that is current asset. So all the things that can be easily converted into cash, these are your current assets. Like your cash is already a cash. Your account receivable, like if you sell to someone and then you expect money in 30 days, 60 days, 45 days, that is your receivable. Your inventory, whatever the items you are selling, you must have some inventories in stock. That is your current asset. Why? Because you did not buy that inventory for the sake of running your business. Rather, you buy it to sell it, or the inventory is for selling. So that's why this inventory is a current asset. The same way, if you have already paid some expenses, let's say if you have already paid your rent for the year, that is your prepaid expenses. This is part of your asset because the rent is not yet due, but you have already paid it. Sometimes businesses are investing in other businesses in terms of like sister concern. They are feeling hardship, they just give some money to the sister concern so that they can work on it. And once they have the money back, like maybe their payment is stuck somewhere, you transfer some money to your sister concern account. Like sister concern means the business owned by the same owners, so they transfer that money to other account. once they pay the employer's fee, employees salaries, other bills and everything, and then when they get their money from their sources of income, they return that money to the bank, to this company. So what will happen? That is an investment to the other company. Another thing, sometimes you are investing in shares, stocks, these type of things. These are also part of your current assets. Why? Because you can all the time sell this anytime, sell those stocks or shares, and you can get your money back. So all of these type of investment that your company is doing will be part of current assets. Then comes the fixed assets. What are the fixed assets? You have that asset, but it is difficult, or it will take longer to materialize the, you can say, the income on it. So not income, to get your money back. So let's say if I buy a land for 24,000, but I know that if I try to sell it right away, maybe I have to pay the legal fees and other fees, or maybe the market is not good. What will happen? I have to sell my property or my land at a cheaper price, so I may make loss. Sometimes even it's good to sell right now, but you don't want to sell it because this is your business property. You don't want to move from your premises. So all of these things that you buy, not for the sake of selling, but for the sake of doing your business, these are all your fixed assets. Buildings and improvement. Let's say you bought a land, you construct a building. Now the purpose of this building is not selling. Like, you don't want to sell your building. You construct it for the sake of running your business. So that property is your asset, but it's a fixed asset. One more thing. Let's say if your business is to buy and sell real estate. So real estate, that property will not be part of your property and equipment. That will become your inventory. Like, you bought 10 properties in different areas, and now you are selling them. So those 10 properties will be part of your inventory, and you will be selling them separately. But if you buy a property for running your own business, that will not be part of your inventory. Those will be part of your fixed assets, which is property and equipment, and you will be putting it here. Always remember, you are the things that you like that can be easily converted into cash, and the investment you made, not for the sake of running your business, rather for the sake of uh, uh, sorry you did not buy those inventories or something for the sake of running your business. Rather, you buy with an intention of selling them or making profit on it. Then those assets are the current assets, but you need to make sure that those assets can be converted into cash uh, in a year's time, or you can make it converted. You can make convert into cash faster. Then those are the one which are current asset. Some of the assets which are taking uh, longer than 1 year, or sometimes you did not buy it for the intention of selling it. So those properties or those assets are called fixed assets. Like, we have some examples here: buildings and improvements, equipments, land. You bought all of these items, all of these assets, just for the sake of uh, like uh, running a business, not for the sake of selling these assets. So these are your fixed assets. And then sometimes you have some intangible assets, which are like your goodwill, or like say uh, sometimes we have the monogram which is registered and nobody can copy it, so you copyright things. So all of these things are physically not there. They are not tangible assets, but you have those assets for the sake of, like, nobody can use them without your permission, or at least no one else can take over or take their uh, take those assets from you. So you must have spent some money to get those things done. So you can just put those money, like your investment or something, as the cost of those assets, as your intangible assets. So if you add all of these type of assets, they will become so they will give you a value. Now let's what so these are the things that your business has. So if your business has cash, if your business has some account receivable, your business has inventories, you paid some expenses. you did some investment, like your business has done is investment. So the question arises from where that money has come. So how that money has come? Maybe you have taken a loan from someone, which is like accounts payable or notes payable, or you have some payments to be made, uh, you have to pay some expenses, or you have some deferred revenue. All of these things are part of current liabilities. So current liabilities are the one which you need to pay within 1 year. Just to give you one idea, sometimes we have taken, like we have example here, long-term debt. We have mortgage a property. We know that we have to pay the property in 30 years. But for this year, let's say if I have to pay the value of the property, I have to pay 200,000 in 30 years. So it means if I divide this 200,000 by 30, so 200,000 divided by 30 years, so I got 6,667 something, right? So this portion I have to pay this year. So if I have to pay this amount this year, I'm just giving the idea. So if I have to pay this amount this year, so this portion is not part of my long-term debt. It is not part of my long-term debt. It will be part of my current liabilities. Because why? Because I have to pay this amount, like even the 200,000 I have to pay in 20 or 30 years. But this much amount I have to pay within this year. So this will be my current liability. And the name of it will be current portion of long-term debt. So this is my even long-term debt, but I have to pay this much money within this year. So this will be my current portion of long-term debt. So this part is very important to understand this thing. Okay, so if you can convert, or if you have to pay something within a year's time, then those are your current liabilities. If you have something to pay in more than 1 year time, those are your long-term debt. So here we have example of accounts payable. Like if you have, like if you buy something from someone and you need to pay them, the same way for the notes payable. If you have some expenses that you need to pay right away, within the year time, that those are what are the accrued expenses. Just to give you the idea, let's say if you are working, just to give you the idea, let's say you are using the premises and you are paying the government bills, or you can say uh, the property taxes, or let's say utility bills, or let's say the if you are paying rent, then the rent, uh, or whatever the type of expense that you are doing, that you need to pay within this year, they are all accrued. Then now, so you have to pay before end of this year, before end of this month. You have to pay this money to government or to someone. So those will be part of the accrued expenses, and those will be part of the current liabilities. So if you ever forget that what's the difference between the current liabilities and the long-term liabilities, just keep remember, current liabilities, as its name says, it's present. You need to pay it now. And when it comes to the payment to payment in present, it means you need to pay within 1 year's time, and that is the part of current liabilities. If you have to pay it in longer than one year, those will be part of long-term debt. The example of long-term debt would be the mortgage, vehicle finance for your business, or plant and machinery when you buy on installments. So all of these different type of like things that you buy on with a loan from the bank, or with a loan from the person. Like in America, I have seen one thing which is like when you buy furniture or something, you can also finance it. So the company who is selling it to you, they say that they can offer you 24 months financing or 36 months financing, this type of things. So those 24 or 36 months financing is more than 12 months. So because it is more than 1 year's time, so they will become part of the long-term debt. So you can put them in this place. But of course, you will put, let's say if the loan is, let's say if you buy a furniture of $5,000 and you have to pay it in 2 years, so you'll be putting in the long-term debt as 2,000, or you can say 2,500 in the long-term debt here, and current portion of long-term debt will be appearing in the current liabilities, because you have to pay half of it within this year's time, or whatever the amount you need to pay within this year's time, you'll be putting it on the top here as the current portion of long-term debt. So yeah, so that's the main bifurcation. So just to give you the idea that assets and liabilities and equity, these are the three main sources, or you can say these are the three main factors for a balance sheet. And assets are comprising of all the assets you have. Either it could be the current one or the like properties, which are the fixed assets. Liabilities are either the, like, you need to pay within a year time, or you have to pay in longer than 1 year time. So these are different type of liabilities. So if you minus the liabilities from assets, you will be left with the shareholders equity. So what is the shareholders equity? Here it says common stock. Common stock means the proprietor's capital or partner's capital. So that money that you have invested from your own pocket into the business. Then sometimes you this is the example of a company which is registered in the you can say stock market or somewhere. But just to give you the idea that sometimes you add additional payment into your business. Paid in capital means uh, when some other investment coming in through any sources, and then you are actually like selling your stocks and getting money. So here, take the example of if someone else also invested in your business, you get that money and then you put it in your equity. Other thing, let's say if you make income in the last year. So now normally, as a business practice, or normally you are keeping 3 years money in the equity area, and then you have to make this equity, your retained earning, into the part of either your equity, or you need to transfer it to any place. Like either you can transfer it to the assets or something within you can say uh, in 3 years time. So normally people are either transferring it to their business, buying any asset or something, or sometimes they actually use this money to divide it into the shareholders, so that they can get benefit of the business they did for a few years. Sometimes you buy you sell the treasury stock or something, then again that will be part of your uh, equity as well. So once you have the entire picture of it, uh, this balance sheet is not showing all the items. I'll see if I can find one more. But just to give you an idea, it's an overview of the entire balance sheet. So if you see this one, you will find that all of your assets has this number, and then all of your liabilities has this number, and all of your equity has this number which is not mentioned here. But if you add this one and the equity part, you will be getting this number, which is equal to the asset side. So yeah, this is all about the balance sheet. Always remember, uh, this is whenever you are actually, just to give you the idea, whenever you are actually increasing the assets, like if your asset is increasing in the accounting, you are actually debiting your assets. So always remember that whenever you are whenever there is an increase in the assets, you will always have it in the debit side. Or let's say if your asset is decreasing, then it's your credit side. The same, all the way around. When there's an increase, you can say in the liabilities, so that will be the credit side. Sorry, this side. And if there is a decrease in liabilities, that will be your debit. So when we are creating the journal entries, so these are the notes for those part. Like let's say if your asset is increasing, automatically you will know that your actually debit is increasing. And let's say if you are feeling that uh, your asset is going down, then it means you need to restore it in the credit portion of it. So these are some of the things that you need to remember. Let me see what other topics we need to cover here. Yeah. So after balance sheet, we'll be start working with the income statement. So let me find some example of the income statement. Okay, let's first discuss the income statement on this sheet, and then we'll move to that. So before starting with the income statement, first thing we need to do is we need to know is the sales. So let's say if I made a sale of 200,000. So if this is my total sales, I must have done some expenses on it. So what could be my expenses? The first one is the cost of goods sold, right? So that cost of goods sold may be comprising of the 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 price, like the cost itself, or let me type it here. So let's say the cost of goods sold is 150,000. It's quite high. Let me make it a smaller one, right? And then you put some labor in it, like you give salaries, or you can say money to bring that asset to your property. So and then of course uh, there's another way of labor is, let's say, once you got that good, you work on that asset. Just to give you the idea, let's say if I am the manufacturer of mobile, so I bought the raw material from different vendors, and now in my factory I am manufacturing that part. So it means I have some labor involved uh, to process that thing. So labor for processing, right? That, let's say, is costing me around 25,000. And then, of course, once you are bringing or taking this asset to other place, you are using transportation. So transportation cost me, let's say, 5,000. So my total cost of goods sold is 125 plus 25 plus 5 is 155, right? So I have to minus this 155,000 from my sales. So this is my, what is this? This is my gross profit. Let me put it here. Right. So this is my gross profit. After I come with the gross profit, then comes the general expenses. What are the general expenses? Like rent, salaries, right? What else? Salaries and bills, like utility bills and other things. Uh, Sometimes you are like all of these type of different expenses that you are paying to your let's say to your workers or to your premises. So all the general expenses, let me type. So all the general expenses are part of your like your will be all of the general expenses. You'll be adding them all, and that will be minus from this. Let me put the numbers correctly. I just put it in the wrong place. So my rent will be, let's say my rent is 2,000. Salaries, let's say I pay during the year is 10,000. Utility bills I pay 2,000. General expenses, let's say uh, just let us make it 20,000, because utility bill amount and this amount was almost the same. So 20 plus 10 is 30, 32,000. So total general expenses I did was 32,000. So what is remain, like once I minus this 32,000 from this 200,000, what I left with here 45,000. After minusing this 32,000, I'm left with 13,000. So this is the impact on my business. And then here I paid the, so this is my net income before interest and taxes, right? So let me put it here. Don't get confused with it. I'm just making the things more understandable. Otherwise, it's already.
Watching this video a couple of times before.
So here is the example, like total sales is this much. We spend this much money, that is equal to this much amount. And then the gross profit will be this minus this, which is here. Then I spend other expenses and I add all of them to make this total. And after, from 45,000, once I minus this one, it becomes 13,000. So let's say on this income, I have to pay, let's say 1,300 as the tax. So I paid, so let me make it bigger. Yeah. So let's say I pay interest. Interest of 1,000, and I pay taxes on my business as 1,300. So all in all, my total amount is 2,300. I'll be minusing this 2,300 from this 13,000, and my net income is 10,700. So let's read this thing from here. So let's say if my sales is this much, what are the direct costs involved? So let me give here example of direct. Let me type it here. Direct cost. That will be cost of goods sold, labor, transportation. So I spend already, once I buy something, this much money. So that is my direct cost total. So once this is my direct cost, I'll be minusing it from my sales. I'll be getting the gross profit. This gross profit is the profit which I earned after only applying the direct cost. Here comes the other things, like I may have paid the salaries to the office staff. I may have paid the rent for my property or the office. I paid my utility bills. All these general expenses are combined together to make the general expenses. Then from my total like gross profit, I'll be minusing this amount, because now I'll be left with this amount. This is the amount which is my like net income, but I have not yet paid the interest on the borrowing, on my borrowing, and also I have not paid the income tax. So I'll be paying, let's say at the end of the year, I'll be paying interest and taxes, and this will become my end of the year profit for the end, like for that business. So this example I've given you is step by step, but let's see one of the good example on the internet so that we can search, like we can see the more legible examples of this one. I don't know why it's not like coming up bigger, but let's see. So revenues and sales are same. So you can see here, whatever the sales I made during the year, I put in this place. And then cost of goods sold. Cost of goods sold is the direct expense. Like if you are bringing your stuff from X place to Y place, that is your direct expense. So all of these things, you apply your labor on some processing, that is your direct expense, because you are not selling the raw material, you are selling the finished good. So You are not selling the raw material of the mobile. You are selling the mobile itself. So you are manufacturing it and then you are selling a finished good. So your labor on that product will become the direct cost. Uh, Even when you are making the screen, just for the sake of understanding, when you are making the screen for a mobile, so it's not necessary that you are actually selling it directly after buying it from the vendor. Rather, there are chances that you are the one who actually manufactures those screen. So whatever the items you are inserting in that screen, you may buy it from some other vendors. So it keeps on going. The person who put labors, like real labor on in processing, they will put that labor value in the cost of goods sold. And the gross profit is the one which is like your earning from that business. Once you have this like earning or business income, then you will be applying the operating expenses, which I mentioned in my Excel sheet as journal expenses, I think. Right, yeah, here it is, journal expenses. So that is your operating expenses. Operating expenses means salaries to the office employees, or other. They just make one. They just make it here, which is not the right place. I don't know why they put it here. Uh, but yeah, so all other things like depreciation, rent payment, yearly bills payment, all of these will be the operating expenses, and those will be the part of those will be added here, and then total income will be this amount minus these amounts. So your this operating income, or you can say income before interest and taxes, will be here. Afterwards, once you pay the interest income and your income tax expense, or what income tax expense, whatever the amount is, once you pay, then the leftover will be your net income. So this is what we have just learned. Uh, the income and income statement, balance sheet. Uh, uh, if you have any question, we can continue. Otherwise, we are good. Like until here.
Yeah, I'm
You want
good.
me to? You're good.
I'm good. Yeah, I'm gonna watch the video again like later. So yeah, I'm good.